Hello, Brian Turner here with another mortgage video installment. Today we're going to go over some mortgage terms, understanding the process, Mortgage Terms 101. The first thing that we're going to go through is the appraisal. The appraisal is the assessment of the property's value. It's a third party that the bank hires to go out and professionally appraise the value of the property. Next is the APR, the annual percentage rate. This is the total cost of your loan expressed as both a percentage per year and takes into account the closing costs and note rate. So it's a good thing. Next is closings. The closing is the process that finalizes the loan package. Once everything's done, the appraisal's in, you've been through underwriting, everything's approved, you meet at the attorney's office, and they have what's called a closing. You sign the papers, and then there's no turning back at that point. Next is a conforming loan. That is a loan that conforms to Fannie Mae or Freddie Mac's guidelines. We're gonna go over more of that later, but that's when you get the loans with the really low interest rates. It's because it conforms to those guidelines. Next thing is your debt ratio. That's the borrower's total debt compared to their total income, and it's expressed in a percentage. So say for instance you had a total monthly payments of $1,000 a month and your total income was $2,000 a month, your debt ratio would be 50% because 1,000 is half of 2,000. So when you hear mortgage people talking about debt ratio, that's what they mean. Total monthly debt divided by total monthly income equals the debt ratio. Down payment, that's the portion of the purchase price that you pay at closing. So if you're going to buy a $100,000 house and you're putting 10% down, that would be $10,000 that you're bringing as your down payment. An escrow account. In order to get the best rates and terms, it's usually necessary to pay 1/12 of both your property taxes and hazard insurance. These funds are put into what's called an escrow account, and then when they become due each year, your lender pays them. So an escrow account is something you set up with your lender, and you pay 1/12 of your taxes and insurance because there's 12 months of the year and you make 12 payments. And then when everything becomes due, the lender goes ahead and pays them. There's two things good about that. A, you get a better interest rate if you do it, and B, your tax bills usually due at the end of the year, December 31st, which is Christmas time. So it's a terrible time to get a big bill. So I prefer them. Fannie Mae, the Federal National Mortgage Association. This is it's a private agency that what they do is they insure the money that mortgage companies make. So if you make a loan that conforms, they'll insure the loan, and that's why you get better interest rates. One thing to keep in mind, Fannie Mae does not actually make loans. What they do is they work with lenders and make sure there's no shortage of funds available for mortgage loans. FHA, that's a government type loan. The FHA is the Federal Housing Authority. What they do is they guarantee loans by making it easier to qualify. This is usually really good for first-time home buyers because they tend to ask for less money down and they have relaxed underwriting guidelines. So it's good for first-time home buyers. FHA. FICO scoring, that's your credit score. It's basically a calculation that's based on a whole slew of things, but it's timeliness of payments, amounts available on your credit lines, numbers of inquiries, number of open accounts, history of bankruptcies, judgments, collections. All of these things are put into a computer model, and they spit out a credit score. So when people say FICO score, they're talking about your credit score. Freddie Mac, Federal Home Loan Mortgage Corporation. This is a similar group as Fannie Mae. They kind of do the same thing, except one thing they do is they work with multifamily residential mortgages. So they kind of have an extra part on it. But what they do is they guarantee loans. So mortgage lenders can sell their loans to Freddie Mac and use proceeds to fund new mortgages, which in turn increases the money supply to home buyers. The company does not make loans directly to home buyers, but